Welcome to the daily update, where I'll go over the action in the market for Thursday, September 4th, and we'll see how things look for Friday, September 5th. Okay, we're pretty much right back where we were a week ago. It was last Thursday when we were above long-term resistance and actually looking to close above it if we had a Friday close above that level at 64.68. We're above it now. We're actually above 6,500 now, just barely setting a new all-time high with the S&P. And then in another way, we're similar to what we were a month ago when the market was looking pretty good. We were going up, seeing some positive conviction, and then the employment report came out and it was not taken as well. We gapped lower. We ended up closing below the 20 period moving average. We quickly got that back, but it's kind of a similar setup right now. Now we are back above the 20 period moving averages right now. And we recaptured that on Wednesday. But now we have the employment report coming out. The market is expecting it to be weak so that it will justify the Fed coming out and cutting rates. But if it's too weak, that could freak out the market. And is this already built into the price of the S&P right now? Are we going to see buy the rumor, sell the news type of a thing? So it's kind of a wild card right now with a very similar setup. Now, we have to close above that 64.68 level to get above long-term resistance. This is the third week. And if we don't close above that, this will be the fourth week that we'll be dealing with this same overhead resistance, which can be good in and of itself, and I'll try to point that out when I get to the chart. Usually when we hit pretty significant resistance, we hit it and then turn and go the other way. We've been dancing around this level now for 3 weeks, and with this right now above that level, and that's quite often can be a pretty good sign. So the market's just waiting to justify going higher and staying higher on a weekly basis. Okay, so right at the open, we had a gap higher open right at R1 at 64.63. And then we came back a little bit. We came all the way down to the unchanged level, which acted as a support level. And then we rebounded back above R1 and we got above R2 at 64.77. We continued to climb above R2 and we closed above 6,500. So we were up 0.83%. We're still below average with volume. And that's a classic technical analysis negative divergence when we're going up on price and we're below average based on volume. Okay, now some people don't put a lot of importance into that. Sometimes it can be a really big deal. It's not as black and white as you would think. That if you read some technical analysis books, it's like, oh, price is going up, volume's going down. Oh, we're going to have a real big decline after that. It's not quite that simple. We've seen a lot of instances over the last few years where the S&P has gone up and volume has dropped off, and it kept going up even higher than that. We saw other times when price was going up, volume was going down, and then it led to a decline. So we just want to be aware of that, is where I come out. And we're positive on all three time frames, short, intermediate, and long term. Interest rates continue to drop. We're actually trying to break below this range that we've been in, and that could be positive for stocks. But if we continue to drop, interest rates might become oversold, price might become overbought with the 10-year yield, and we might see a bit of a reversal there. We'll see how the market reacts to the employment report in Friday's session. And then all the geopolitical things that a lot of it's more domestic right now. There's stuff going on all over the place, but it's not really having an impact on the market. Okay, some comments. We did set a new all-time high with the S&P. There's more Federal Open Mouth Committee coming out right now. John Williams, isn't he a famous composer? Wrote a whole lot of music scores. Stated that he anticipates interest rates moving toward the neutral levels, citing a gradual cooling in the labor market. And this is what the scenario is that the market has picked up. We've heard this from other Fed or FOMC members, both voting and non-voting, that say it's hinging on the labor market. Well, we have the biggest report coming out of the month that's going to feed into the employment situation as far as information of how things are going. And it's kind of a roll of the dice right now how that report's going to come out. And now the Fed's probably already seen this report. They get this stuff before we do. I mean, so you have to think maybe there's something to what he is saying. And then after a couple of days, the parabolic SAR has now turned back positive. Now we're still seeing more of a mixed picture and some weakness developing in the intermediate term. We're seeing a little bit of a pickup in the short term with positive conviction, but after spending a few days with the dots on top, now we're back with the dots below with the parabolic SAR. That's an intermediate term indicator that has now gone back to positive. Seeing a little bit more conviction here with the Williams percent R, CCI 14. Just a couple days ago, this was on the list. Then we have a down day and they come off the list. And then the stochastics, which seem to be there pretty much all the time anyway. And we're getting concerned about one of our smart money indicators, the Chaikin oscillator. It's getting up into an extreme reading area, and I'll show you that chart and I'll just kind of point out what I see happening there. And then the Sean trend meter is starting to look extreme again. We're going to see if something happens with the employment report and does that alter the overall scenario that the Fed has been keeping rates higher for longer. They're worried about inflation. Now, that still goes back a few weeks when PPI came out. That's still on the back burner, but the market's focused on employment right now. They're worried about employment going down and inflation going up. Well, CPI came in friendly and the market liked that, but then PPI came out a couple of days later and that showed inflation. All right, so there's a little bit of uneasiness there. Now it's like, okay, how's employment looking? Because that's another real key factor in the Fed making a decision. The dollar was up, interest rates were down. See, we're down to 4.18% after we had been at 4.21%. And even the 4.21% was quite a drop. I think it was 4.28% just a couple of days ago. So this is a pretty significant drop in a short period of time. And we're still ticking down. You've got some hedging going on, you've got some apprehension in the market. So sentiment is not really following what the market is doing. We're seeing a bit of a disconnect there, or we actually tick down. We're still neutral at 52, but usually on an up day, we would see this number go up. It had been at 54, we would see it increase. Instead, it's actually ticking down. I checked it like 3 times to see if there was a mistake with that, but no, we are more neutral. And what 50 is the line. A little bit above 50 is more positive, a little bit below is negative before we actually show more conviction, either positive or negative. We are positive with the trend. Now, we had switched over after last Friday and Tuesday with the down days. We were looking more negative with our trend. Now, with so far, when we have Wednesday and Thursday session, we've been able to switch back to positive. It's still a weakening trend though, because we're going back and forth between positive and negative, and the ADX is still declining below its moving average. But we're still above 20 with the intermediate term. Now we're dropping below 20 with the short-term chart. So that shows that we're not really trending now and not really showing a strengthening trend that has a lot of conviction. But with the up day, and that usually if we have an up day or a down day, that's the bias and it's positive. And I've changed the momentum a little bit where we were mixed to negative. Now we switch back over to just mixed, and now we're more mixed to positive because we've been going up. All right, we did get the ADP employment change, which still has new jobs out there, 54,000, but much weaker than expected. They thought it was going to come in at 69,000 and way down from the 106,000 that we saw last time. The trade balance, a little bit more than what they had expected, minus 78.3 billion. They thought it would come in at a minus 64.2 billion, and also quite a bit of a rise from the last reading at minus 59.1 billion. This is the imbalance between imports and exports. Then second quarter productivity, 3.3. They expected it to come in at 2.4. Now this is actually kind of a sweet spot type of report, and you'll see in the next line too. You want to have productivity up, and that's what happened here when they revised this number. You want labor costs down, and it came in less than expected. Where when we first saw this, it came in at 1.6%. It was revised down to 1%. So an increase in productivity and a decrease in the cost for having that productivity. And from an economic standpoint, that's more positive. It kind of sucks if you're an employee. And then the weekly claims, did go back up here to 237,000, but we're still within a broader range that we've been in. So that was more than expected and also up from last week's reading. Continuing claims actually ticked down a little bit. We're still below the 2 million level, but we're stubbornly high. And this is still suggesting that those people that do get unemployed, usually they start off on the weekly initial claims, and then if they stay unemployed, they go to the continuing claims, and they're staying on there longer, even though we saw a little bit of a decline with this reading. And then we had the global services PMI came in at 54.5 and last time it was at 55.4. It's still above 50, so it's showing expansion, but a little bit of weakness there. And then this was the other big report, and this was strong. The ISM services, 52, above 50, and also well above the 50.5% that they thought the reading was going to be, and up from 50.1 from last time. So this is showing a relatively robust economy. So here are the weekly jobless claims going up here, but you can see when you go back over the last couple of years, we're just still within the range that we've been in, but the moving average is also going up. And we are coming down, but we're still stubbornly high here with the continuing claims. We're not seeing a real drop off here. Now the moving average is starting to come down, but we were in a lower range for quite a while, and then now we've shot up to a higher range and not seeing much change there. So just to give it a little bit more context, the red line, these are the initial claims which are going up, still pretty much going sideways with the continuing claims, and then the latest reading with the unemployment rate, which will be updated in Friday's session, coming in at 4.2%. And then the ADP employment change, positive, but dropping off from the previous reading. And then the challenger job cuts. Employers announced 85, almost 86,000 job cuts in August, an increase of 39% month over month. And you annualize that, that's 13%. So that's a lot of jobs that are being cut right now. And so we're seeing this number coming up. And ADP employment change rose by 54,000. That's the number I just talked about, falling short of the consensus at 65,000 and sharply lower than July. And they got a lot of rainbow colors in here to kind of make it look pretty. But this is a further breakdown of that report. And productivity, we're going up with the blue line. That's productivity. In unit labor costs are still going up on an annual basis when you do this year over year, even though we saw a more friendly report with the month over month change. And then the monthly nominal trade balance, it had been becoming less. And that has to do with these trade deals and tariffs and so forth. We did see this tick back down, showing that there's more of a deficit there. And the nominal exports and imports year over year, we're going up with the imports, we're coming down with the exports. And then the deficit, seeing a bit of a decrease or increase. It looks like a decrease, but it's a bigger negative number. So it's actually increasing on this chart. Then the non-manufacturing, or what we also call the services, the total is above 50 and going up. That's the blue line. And then the prices are actually coming down a little bit. So we saw a little bit of an inflation tapering off there. And that is another positive thing that the market picked up on. All right, and we have margin debt and free cash balances. Buy every dip. Market's been positive. People are willing to get margin to buy their stock. That works great when we're going up, but it can also fuel the fire if we start going down because that's borrowed money that has to be paid back. And as I explain every time we see this chart, if you have, let's say, $10,000 in your account and that allows you to buy $20,000 worth of stock because you're borrowing $10,000 from your broker, and the stock goes down, it's not a split the difference with your broker. You still have to pay that entire $10,000 back. And that's what can really bite into your profits. So it's a great tool when it works for you. It can be a double-edged sword when it starts to really go against you. And a big summer rally is usually bullish. Now, there's one exception here, 1987. That's not a very good year. That's kind of ruining the longer-term averages and medians and so forth. But it's just strength tends to beget strength. When we look at June through August, going back to 1950 and all the years, but then this shows, especially for the rest of the year, that things are more positive. But even though September quite often can end up being negative. So we're still looking at the bigger picture. Now, September so far is defying the seasonality, but we're just still at the beginning part of September. And we waited, again, if you watch these videos very often, I've been waiting at least to see if some kind of a decline was going to happen since the middle of July. Not predicting anything, just saying, okay, this happened in 2023. It also happened in 2024. Let's see if it's going to happen in 2025. It didn't in July. It didn't in August. And we'll have to see if it's going to end up developing in September. That's why I do these daily videos. We can pick up the subtle little changes that way. And here we get this all the time, just showing how the market is overvalued now, especially when you compare it to the rest of the world. Systematic equity positioning coming down just a little bit, but still positive. Most are positioned in stocks. That seems to be the place to be. And then the US market has consistently outperformed the rest of the world over the past decade. Not now. This is in market cap here, but in performance, no, it's underperformed in 2025. But most of the money still continues to go into American companies and into the US stock market. Average and median monthly 10-year treasury yield change going back to 2000. Okay, then it flips over and looks more negative in September. Tell that to the first few days of September. We've actually been coming down here with the 10-year yield. And then these are announced buybacks. Now, these aren't actual buybacks, but we're seeing a lot of buybacks being announced in the financials. And we're still seeing the financial sector doing okay. And it's trying to get back that underperformance with the S&P 500. Well, we're going up with a lot of the financial stocks, and those are the areas that are announcing the most buybacks. With industrials, they've been strong this year, tech and discretionary. And so it's like, hey, we're going to go in and buy our own stock. We have confidence in it. But an announced buyback is different than the actual buyback. Gold and silver doubled during 3-year bull run. So they both have been doing quite well, making the gold bugs really happy there. They've been declaring this for decades. And now that it finally happens, they can pat themselves on the back and say, look and see, I was right all along, even though you've been declaring this for 20 years. And then the global financial conditions. This going down, that means things are easing a little bit, and that is helping to for stocks to go up, not only in the US, but internationally. And then this also talks about the dominance of the big companies is a function of their vastly superior earnings over the past decade. And this is one of the big reasons that right now is different than the dot-com boom. Now, there were companies, Microsoft was still around, Intel, IBM, Micron Technology, AMD, those companies were still there back in the dot-com boom. But you had all these new dot-com companies that were just dreams, were just ideas, and it was a hype thing where there's more in the stocks that really control the market, the Magnificent Seven, and that's why the market is holding up and doing well, and also how it's different from how we look back at the dot-com boom and then ultimate bust. Okay, then U.S. sector PMI, just looking at all the different areas here. August highlighted a rise in business activity across 7 U.S. sectors monitored by the survey, up from 5 in July, and the first broad-based expansion since February. Okay, so just looking here, breaking it out by sector, and is the business activity increasing or decreasing in those areas? And we're seeing a general improvement there. Then the MOVE index, which measures the volatility of bonds, I'll be going over this in the weekend videos. That's picking up a little bit here. I'm not really seeing that on the charts that I look at, but this, where the VIX measures volatility of stocks, the MOVE index measures the volatility of bonds, and that's been picking up, which is, this might be a little outdated. I'm not sure when this was actually created, but bond prices have been going up and rates have been going down. And that usually makes the MOVE index actually go down overall, but here they show it going up. And then AI adoption rates, we're starting off and we're just going back over the last couple of years. The adoption, companies that are starting to use AI, and there's still more room to run to the upside here. The percentages are still pretty low. They're still duking it out to see, okay, what platform is going to rise to the surface. It's like right now, you've got Chat GPT, you've got Grok, you've got, Claude, you've got all these different answers out there. What's going to eventually rise to the top? And that's what these companies are doing. And that's capitalism at its finest. Just we all have an idea. We're all trying to get to a goal. We all want to have an edge over everybody else. So that means we need to make the best product for the least amount of money. Okay, so here's the chart. And we did gap up, came down to the unchanged level, and then spent the rest of the day going up. Pretty healthy look here. Not quite back to this intraday high here, but we were able to stay above just barely the 6,500 level to set a closing high. And then intraday, kind of quiet, a little bit of drifting up here in the initial overnight session. But the futures have been relatively quiet. It's during the cash session, as I've been saying, this is when we're seeing most of the price movement. Instead of, there are days here and there when most of it comes from the gap, but a lot of the price action is happening during the day itself. But we're still not seeing an awful lot of conviction. We're just kind of seeing a drifting higher, drifting lower. We have a couple of up days, we start to lean more positive. Then we have a couple of down days, then we start to lean more negative. But there's not an awful lot of conviction behind these moves, which has made it more tricky to ride this thing out. We are seeing an improvement here. Intraday growth to value chart, both the red line and the blue line are going up. Now they can still go up. We would like it if the blue line actually crosses above the red line. Not quite there yet, but both are improving. And we are improving here. We're seeing a bit of a trailing off here with the growth to value ratio for the S&P. Now this is at least stabilizing. It's not really outperforming at this point, but it's not going down anymore either, at least currently. So end of day, growth was up more than value for the large caps, up more for the mid caps, and up less for the small caps. So still drifting off here with our end of day small cap growth to value ratio, still below the 50-day moving average and going sideways with mid cap growth to value, and improving a bit, but still below the 50-period moving average with S&P growth to value. This is what I've been pointing out. Going back to the beginning of August, we've been seeing a trailing off of the growth to value ratio. The longer term is we're still positive. So right now, if we do see some kind of a decline that lasts more than a couple of trading sessions, it's looking more like a pullback here. But this is more defensive, and that hasn't really taken care of itself, at least yet. Also, a bit of an improvement, but still in the rainbow with this growth to value ratio. This has been improving, discretionary to staples, and that's encouraging. And it was about in August a year ago when discretionary, after we had those really significant down days, and discretionary ended up being the best performing sector for the rest of 2024. Is something similar going to happen here with 2025? Okay, and we're still not trending here in the short term, but we're positive with the green line going up and the red line going down, and the green line is above the red line. Also, after spending a day or so being negative, we're looking more positive here in the intermediate term. Green line going up, red line going down, green line above the red. ADX still continues to drop off. Where in this previous chart, we're still below 20, and we're also below the moving average. That suggests we're not trending, and the trend is still getting weaker. We are seeing a weaker trend here in the intermediate term, but we haven't dropped below 20, at least yet. And we're still below average with volume here. And not, you'd like to see this above average. That would just show more conviction. So coming back down below the moving average with the VIX, with the line chart, as well as the bar chart. So fear coming out of the market that way. But this is seasonally what typically happens with the VIX. It hasn't happened yet. We're not seeing it play out, but this is can develop into a weaker period of time, and that's when the VIX is going up, which means stocks are going down. And coming back down to the moving averages with the VIX of the VIX, both with the bar chart and the line chart, kind of in between the two moving averages here. Coming down, but still in this red area. When we look at the skew index, the market is still anticipating some kind of a big move that hasn't at least completed yet. And then we every week get the individual investors still more negative than positive. And this could actually work out to be positive for the market because individual investors aren't really exuberant right now, and they haven't been exuberant, and that's been helping the market to go up. When they finally capitulate to the upside and say, okay, wow, we're going up with the S&P, we're setting new all-time highs. Yeah, I'm going to go in and I'm going to buy. That might be about when things end. And as far as these folks being more pessimistic right now, could actually work to the market's favor. But at the same time, for taking it what it is, they are still net negative overall. And there might be some wisdom in that as well. So we declined with this fear gauge and we declined with this other fear gauge, seeing a little bit more confirmation there. A little bit of a tick up with the daily chart of the equity put call ratio, but we're still going up with the 5-day chart. We're starting to roll over just a little bit here with the 10-day chart. So not seeing real confirmation there. And coming down, but we're still above the band here with the volatility risk premium. Now, if you go back and you look right at the end of July, we weren't seeing this in the VIX. We weren't seeing this in some of our other fear gauges that we look at, but we were seeing it here. We were getting a very high reading here at the end of July, and then the employment report came out, and then it really dropped down after that. We're not seeing as high of a reading right now. So that's one way that things are a little bit different right now than they were a month ago. And then the advanced decline line, not setting a new high here, but still turning up and positive in the bigger picture when we look at price and volume. We're back above zero here with the short-term advanced decline ratio and going back up with the blue line and the red line. So we're a little bit back above zero now with the advanced decline line based on price, and we're back above zero based on volume. And this is just a further breakout of the short-term advanced decline ratio, just barely above zero now with the advanced decline oscillator. You can see going back through July, we go up a little bit, then we go down, then we go up, then we go down. Not an awful lot of longer term conviction with the advanced decline line here. And rolling over with the 5-day and 10-day charts, but we did see an expansion of the new highs here and pretty flat here with the new lows. So this is still looking more positive, a lot more green than red currently. And we're looking good with our smart money indicators, maybe a little too good here. We're potentially getting kind of far away from the moving average with accumulation distribution, but we're above the advancing moving average, and that's positive. Shorter term, now this boom indicator is supposed to measure the distance from the indicator to the moving average, but it doesn't really work all that well. So this is more of a short term momentum type of indicator since it's a modified MACD indicator. And this is still going up. We're making higher highs here with the Chaikin money flow and the red line's continuing to go up. But now we're above this green line with the Chaikin oscillator. And sometimes it doesn't necessarily mean a reversal, but it could mean that we end up slowing down when we get to this level. And it's like, man, there's not a lot of conviction in the market right now. You mean we're going to slow down and have even less conviction? Okay, that's one possible scenario. Or are we going to actually see some kind of a reversal with that ends up developing into a more significant decline or pullback? And we're back to positive now. For 2 days, the vortex had the green line and the red line at the same reading. Now we're going back up with the green line and down with the red line. And back above the moving averages here with all the different indexes that we look at. We were seeing some weakness in the mid caps and small caps. Now they're back above their moving averages. And we look at those stocks or above their 20 period moving averages there, still above 50. In the bigger context, though, we're still seeing a longer term negative divergence here. We've been making lower highs here as the S&P was making higher highs. But to read this for what it is right now, the fact that it's above 50 and advancing is positive. Also, going back up after declining with the 50 period moving average study, also you can make a case for a negative divergence here, going down with this indicator while the S&P was going up. Not as much of a negative divergence here. And we tick back up slightly with the 100 period moving average study and 200. Now, this is actually not showing the negative divergences here. We set a high, then a higher high, then a higher high, then a higher high. That's longer term more positive, and that's why we're more positive in the long term. So here's the daily chart just coming back. We've been here before, and even though we closed at a new all-time high, we on an intraday basis, we've been at these price levels not so very long ago. We had the gap down, and then we were able to fill the gap, and now are we seeing a similar pattern? This was a month ago, but things were doing okay. Now, we did see a weak Thursday before the employment report came out. We opened at the high and closed at the low. And then the employment report came out, and then we gapped lower. We ended up seeing some support at this daily pivot point. And then we came up here, and then this was creating what's called a bearish flag. And everybody's like, uh-oh, we're going down the hill here. We're going to be in the toilet for a while. Well, we went back up and actually set another new high. Started to come back down. Now we're going back up. Now we're coming down. Now we're going back up. It's like a roller coaster currently. But in the bigger context, we're still above the 50 and 200-day moving averages. We're still in an uptrend, but we continue to be below average with volume. Ticking back up slightly and getting back above 50 with the 20 period moving average study. We're going back up slightly with the 50 and the 200. And we're crossing above the midpoint with the Stochk RSI. And after seeing some weakness here, we're back to looking more extreme with the Williams percent R, which is showing more positive short-term conviction, and just a little bit below 100 with the CCI 20, and just a little bit above 100 with the CCI 14. So if we see more follow-through upside, that will probably help the conviction turn more positive. If we end up going down in Friday's session, that's going to put us back into non-conviction land. And then short-term stochastic getting pretty high here above the moving average, extreme, turning back up, but still below the moving average with the intermediate term, turning back up and extreme positive with the long short-term stochastic, and crossing back above the midpoint with the force index. So that's positive there. And trying to turn back up here with the short-term trend, both the green line and the blue line. We spent a few days down below it, so the short-term trend was looking more vulnerable. Now we've been able to come back above it, and that's helping the trend. And we're back up into the +2 channel now with the standard deviations chart. That's looking better there. We did turn back up and we're above zero with the balance of power. We're switching back to positive with the go, no go, darker blue bars. We're above the midpoint and starting to hit the highest high line here, which is the blue line. That's positive. And then the Landry Light, day 87 now of this upward trend that began, according to this, right at the beginning of May. Also, still positive with the proper order. Still negative, though, with the TTM squeeze. Going down, darker blue. That's a bit of a negative divergence, but we've been so choppy lately here. It's like diverging from what? Well, we've been going up, and this continues to go down. So that's more shorter term of a negative divergence. And slightly back above zero with the ease of movement. Still positive with the Arun. We're above zero with the oscillator. Improving, but still below zero with the McClellan oscillator. This is more the short to intermediate term weakness that I talked about here. We're just bouncing around the midpoint. And when this is below zero, we're declining with the summation index based on price and volume. That's more intermediate to even somewhat long term. And so that hasn't switched over and is looking positive at least yet. And we did cross back above zero, but again, we've been bouncing above and below zero with the NYSE McClellan oscillator. So we're barely starting to tick back up with the summation index. We're still going down, it looks like here, based on volume. Maybe it's up just a little bit, but it's been so choppy lately, there's really no conviction there. We're still declining. Now we're flattening out here based on price, but we're continuing to decline here based on volume when we look at the Swanland trading oscillator. Momentum continues to drift off, and we're actually still below the moving average based on price. We're even more below the moving average based on volume. But we did improve with the PMOs that are rising. However, we're still below 50. And we're flat here, and we're also still below 50 with the buy signals, and we're continuing to drift sideways and still well above 50 with the PMOs that are above zero. And we've gone, this is interesting. We negative, neutral, positive. We kind of switched pretty quick with the Elder's Impulse system. And now we have a dot underneath with the parabolic SAR. We spent 2 days with the dots on top, which is strange. Usually we see that last longer. If you go back and look at these things, we had a 1 day jobber. This was back in July when, turning negative, but then we quickly got that back. We were trying to turn more negative. We didn't really get negative in August because the recovery was pretty quick. So then 2 days here, and now we're starting to go back up with the S&P. And we're still negative with the slope oscillator. It's declining below its moving average, still declining with the MACD. So all of our momentum oscillators, short, intermediate, and long-term, continue to be drifting lower. They're showing a little bit signs of improvement, but really no conviction right now. And we're negative with the Copic curve momentum oscillator, starting to come up here, getting into this initial overextended area with the Sean trend meter. It's really extreme if we get up to the dark green area, and we're not there yet. Above 50 and going up with the ultimate oscillator, just barely going back above 50 with the money flow index after it had dropped negative. Still above the moving average with unbalanced volume. And now this is positive with the intermediate and short-term RSI. We dropped a little bit below 50 with the short-term. But you can see here, as we've generally been going up with the S&P, we've been making lower highs here with both of these RSI charts. That's another negative divergence, which part of it is due to how these are calculated. The other part is due to a self-fulfilling prophecy, and that they're just not showing the strength that we were seeing earlier. Okay, then we're still above the short-term moving average here with the 10-period simple moving average when we look at the bow tie method, and the lines are continuing to go up. That's positive there. And still going up with the red line and the blue line with the intermediate term trend. We're just barely coming back up into the blue line right now, but it hasn't really damaged the intermediate term trend all that much. We're above all the moving averages here, and all the moving averages continue to go up, but we're still declining with the bullish percent index. And these are point and figure buy or sell signals inside the S&P. And when you combine this with the summation index, those are still negative, even though we've been going back up here based on price. And that's also showing a bit of a negative divergence as well. And we actually declined a little bit, but still above 50 with the NYSE bullish percent index. Still below 50 and flat. This is actually negative because we are below 50 with the NASDAQ 100 bullish percent index, but we still have this praying bottom fisher. And I'll keep showing this chart until the black line comes back down and crosses below the red line here. I don't use this all by itself. It's a buy signal, okay, but we're not seeing an awful lot of confirmation on the other things that we look at. All right, and this is probably the most important thing. It's been the most important thing for the last few weeks. This is a weekly chart of the S&P, and as of right now, we're above this R1 pivot point. And we were there a week ago, and then we closed down below it. This is 64.68. When you round it up, it's actually 64.67.59. And we were there last week and closed down below it by the time we finished on Friday. Now we're above it right now. Are we going to be able to go up from here or are we going to go down from here? And you can see other times when we hit this level, we didn't stay there very long. Came down here, hit, bounced back up. Came up here, hit, went back down. So it can act as either support or resistance, but it's usually pretty quick. You can go back to 2018. Came down here, went back up, came down here, went back up. We've been hanging out at around this level for many weeks. And now it's negative in the sense that we have not been able to close above that. It's positive that we didn't hit this and it's not acting like a pool ball where, it hits the side and goes in the opposite direction. It's like there's still more of a chance that we could end up breaking above this. All right, now we're at the high end of the trend channel with the S&P going back to 2009. And looking more positive now with the Heiken Ashi that has the open candle. We're positive with the Kagi chart, positive with the Renko chart, and finally starting to look a little more positive with the three-line break. It had been holding out and looking more negative. Now with the open candle, it's starting to look more positive. Longer term, still looking good here with our 150 and 200 period moving averages. Positive on all time frames across all the indexes. And commodities are positive on all time frames. The dollar's still in a short-term uptrend, and we have bonds short and intermediate term positive based on price. And notice down here, utilities, they consider to be more defensive unless you also include them in a growth area because of the huge need for electricity going forward, especially for AI. But you see discretionary leading the pack, then communication. We like the financials were doing well. Tech lagged a little bit here, but it was still positive. So the growth areas did show some improvement. And a lot of green after some initial red here, like the real estate, that's more of a defensive area, had a bearish MACD crossover, as did the materials sector. And then we had the NASDAQ getting above 21.5, 21.6, then it went down to 21.4, 3, and then back up to 21.7. Woohoo, roller coaster ride there. And we got above 6,500 with the S&P. Communication, which is a growth area, had a BPI cross above 70. Another day, another new all-time high for Canada. And we had a bullish MACD crossover here with the dollar. That could pressure stocks if the dollar's getting ready to go back up. A lot of green here, especially when we look at tech, communication, financials, discretionary. Yeah, when these are all green, the market goes up. And the Dow, not really breaking out of this range yet, but still looking positive overall, going from neutral to positive with the diamonds when looking at the Elder's Impulse system. Not back to a new high here with the NASDAQ. And we still have this previous pivot point, which could still be acting as overhead resistance. That's just about where we closed, but it's still looking positive in the bigger picture. And we've gone from negative back to the last two trading days of being positive with the NASDAQ. Also, not really breaking out of this series of lower highs here with the NASDAQ 100. Still above the pivot point, though. Still on a longer term uptrend as well. and positive with the Elder's Impulse system for the Qs, but the momentum going back to late May continues to be negative for the NASDAQ 100. Okay, right as I was recording, I lost connectivity, and when you use Zoom to record, that just stops the whole recording process. So I'm going to have to piece these together for this particular video. I stopped here with the Qs. We're still back above the short-term moving average, so that's turning more positive, at least for the time being. And longer term, we're still above this trend line going back to 2009 for the weekly chart of the NASDAQ 100. Small caps did have a good day, up 1.5%, but still just back to where we were before. Also coming back to where we were before with the Russell 2000 small caps. And turning back to positive though, but not really breaking out here with the small caps with the Elder's Impulse system. Coming up into the high end of the recent range with the mid caps, positive with the Elder's Impulse system and not quite back to an all-time high yet. Okay, and this connectivity just happened again here. But now looking at the total US stock ETF, we're not quite back to an all-time high, but still looking quite positive, and that's a broader market measure there. I'll just keep doing these little chunks and then I'll splice them all together. This is the financial sector, not quite back to an all-time high, but still looking positive all by itself. This has not been the concern. This has been the concern. The ratio between the financials and the S&P. We were improving here and we've kind of stalled out recently. And we are in a downtrend when we look at the ratio between the financial sector and the S&P. We want this to go back up. That would be much more positive for the markets. And just about at, in fact, probably at a new all-time high here with the FANG index. These are the really big stocks, and they're driving the indexes right now. So Apple was up over 0.5%. We had Amazon up over 4%. That really helped the discretionary sector. Still dealing with the 50-period moving average with Microsoft. Google, the news came out that, yeah, you can keep Chrome, and that means that Chrome can be used for the iPhone, the default search engine, and the market is continuing to really like that. Meta, it was up 1.5%, but well off of its highs, still above its 50-day moving average, and still dealing with the 50-day moving average with Nvidia. Tesla chopping all around, up 1.33%. Netflix finally cleared back above its 50-day moving average, but not back to an all-time high, at least yet. And then looking at the relationship on a short-term basis, starting to get a little bit stronger as it been getting weaker, with the short-term correlation between U.S. and world stocks still kind of drifting down, but trying to level out with the longer-term correlation. And we continue to fall with oil, and that's non-inflationary, but we mainly follow this for geopolitical reasons. And we're continuing to go up. Not an awful lot of conviction with the dollar, but it's at least holding up a little bit better. If we do keep going up with the dollar, that could very likely be negative for stocks. And then we're continuing to drop off here. See, and I tried to point this out. We're not back down to this previous range going back to late April. But this more recent range, we bottomed in July, then went back up. We bottomed in August, then went back up. We're dropping below these more recent low end of the 10-year yield. And that could be more positive if we drop down. But at the same time, if we're dropping down rather quickly, that could put this into an oversold condition for yields, which may bounce back up because that could put us up into the overbought territory with price, which here is price. See how we've been going up pretty strong so far for the 3 trading sessions. We're not overbought here with the RSI. We're just above 50, and we are positive with the momentum with the 10-year yield based on price, excuse me, the 10-year based on price. Okay, improving, but still not looking real all solid with the Qs to S&P ratio. And we're getting back above the moving average with discretionary to the S&P. This has been the stronger area recently where it really underperformed for a lot of 2025. Coming back up to the moving average, but the moving average is still declining when we compare large cap growth to value. So we're slightly above the moving average with the large caps, still under a declining moving average with the mid caps, and we're still trailing off here with the small cap growth to value ratios. So our outlook, we're positive on all time frames when we apply it to the S&P. And right now, anyway, we're above overhead resistance that I tried to point out earlier on. The employment situation report, that is the big news. That's what the market will be waiting for. And then anything geopolitical that may happen as well. And here is the finishing out of the economic reports calendar for the week. This also shows, these are the previous readings that we had and what the forecasts are. According when I took this, which was about a week ago, and this may be adjusted, they're looking at a rise of 78,000 new jobs, with the unemployment rate ticking up to 4.3%. So we'll see if the market comes in close to what they're anticipating the forecast to be. And no real edge here when we look at September 5th, going back to 2002, neutral to negative with the Dow, neutral to positive with the NASDAQ. September tends to be weaker, but we're not seeing that yet. This also suggests how September tends to be weaker, but hasn't happened so far. Where the first half does end up performing better, then it's the second half of September. That's the worst performing second half of the month of the year. And this also shows some weaker seasonality. That it didn't develop in August, and so far it hasn't been developing in September. This also shows going back to 1950 how the S&P has not done well in September. So we're still negative when we look at the S&P and NYSE McClellan oscillators and summation indexes. The momentum indicators continue to be negative. The Swindle Trading Oscillator, now it's flat based on price, but it's still declining based on volume. And the bullish percent indexes, now we are technically still positive with the NYSE because it's above 50, but it's not showing an awful lot of strength right now, where we are declining with the S&P and we're actually negative with the NASDAQ 100 bullish percent index. It's below 50 and continuing to decline. And then the momentum for the NASDAQ 100 is negative. Then on the positive side, our smart money indicators are looking okay, but we might be extreme here with accumulation distribution. We are definitely extreme with the Chaikin oscillator. And then the growth to value ratios, they're still positive longer term. Really, if you go back to the beginning of August, this is when we saw that shorter term switch over to the market becoming more defensive. But discretionary to staples is actually doing quite well. And the parabolic SAR is now back to being positive. And we do have the bullish percent. It's on the positive side here because it's above 50. And the ease of movement is back to looking positive, as is the money flow and the ultimate oscillator, where these were going back and forth between positive and negative. The vortex, after spending a couple of days at the flat or even reading there, we're looking more positive again. And the financial sector, but still, it is tending to underperform the S&P, even though we've been seeing some recent improvements with that ratio. And then we're on a praying bottom Fisher buy signal. And then longer term, and I'll be covering these in the weekend video, the special K daily chart and weekly chart continue to be positive. Here are the pivot points for Friday's session, kind of wide because we had a pretty good move up here. Now, for R3, we didn't get up there. It was above current price, and we were going to need to go quite a bit higher just to get to that. And so since we had a fairly wide day on Thursday, that's making the pivot points fairly wide here for Friday's session. So the conclusion, we're still positive on all three time frames. We're above overhead resistance, and we're wondering, can it hold? We were here a week ago, and it did not hold. Is it going to be able to hold this time? In the short term, we're seeing a little bit more conviction that's positive developing as we're back above the 20-period moving averages. We're still seeing some weakness developing, but there are also some improvements in the intermediate term. The bulk of the charts that I look at really are focused on the intermediate term, and we're seeing some of our secondary indicators, the money flow, the ultimate oscillator, ease of movement, those are improving and actually turning back to positive. But some of the major ones that we follow, the summation index and the bullish percent index, those are still looking more negative. And then we're positive with the long term since we're above the 200-day simple moving average, working off of a golden cross, which is an uptrend. Thank you. I hope you found this helpful. Have a really good day on Friday, and I will talk to you in the next video.